Debt management made easy. I'll guide you step by step through managing and paying off your current debt and share the smartest habits to keep you debt-free for good. After hundreds of hours of research, I think this approach is the most straightforward and sustainable path to achieving adequate debt management. Understanding different types of debt helps you manage your finances better by highlighting how each impacts financial health. Secured debts, like mortgages, are backed by assets and carry lower risk for lenders, while unsecured debts, such as credit cards, often have higher interest rates. Knowing these distinctions allows you to choose the best repayment strategy, like prioritizing high-interest debt, Avalanche method, or tackling smaller balances first, Snowball method, saving money, and protecting essential assets. This awareness prepares you for smarter financial decisions and a more stable future. The most common types of debt: secured debt, backed by assets like your home or car. If you default, the lender can take the asset to recover the loan. Unsecured debt, based on your credit history and ability to pay, with no assets attached. Examples include personal loans and most credit cards. Revolving debt, commonly seen in credit cards and some lines of credit. The amount you owe can fluctuate as you borrow and repay. Installment debt involves fixed monthly payments, such as student loans or mortgages. These loans have set repayment terms and amounts. Formulate a repayment plan. Formulating a solid repayment plan is key to tackling debt effectively. Here are two popular methods to consider. Snowball method. With this approach, you start by paying off the debt with the smallest balance first while making minimum payments on the rest. Once the smallest debt is cleared, you take that payment amount and roll it over to the next smallest debt. The advantage? You'll experience a series of quick wins, freeing up cash flow sooner and building motivation as you see your debts disappearing one by one. Avalanche method. Here, you focus on the debt with the highest interest rate first while making minimum payments on lower interest debts. When the highest interest debt is paid off, you shift those funds to the debt with the next highest rate. This method can save you more money over time by reducing the total interest paid, but it may take longer to feel the progress. Both methods are effective, so choose the one that best suits your financial situation and goals. The snowball approach might work best if you're motivated by visible progress. If long-term savings are your priority, consider the avalanche. Debt consolidation loans are worth considering if you want to streamline payments and reduce interest costs. Here are a few options. Balance transfer credit cards. These cards often offer a 0% interest period, usually 12 to 18 months. By transferring high-interest debt to a balance transfer card, you can focus on paying down the principal without accruing more interest. Just be aware of any transfer fees and aim to pay off the balance within the promotional period. Home equity loans. If you're a homeowner, a home equity loan might provide a lower interest rate as your property secures it. This can be an effective way to consolidate high-interest debts, though it does put your home at risk if you cannot make payments. Debt consolidation loans. These are specifically designed to combine multiple debts into one loan with a fixed interest rate and term. While this can simplify your finances and reduce monthly payments, it's important to remember that it doesn't address the root cause of the debt. Building healthier spending habits and budgeting can help prevent future debt. In addition, negotiating lower interest rates on existing debts can make repayment easier. Sometimes all it takes is a polite, firm conversation with your lender. Before reaching out, review your account history, credit score, and current interest rates so you're well prepared to negotiate. A practical tip: consider freeing up cash wherever possible to apply more toward your debt. Look at your monthly expenses to identify any areas where you can cut back, even temporarily, to increase your debt payments. Each extra dollar you pay down now reduces the overall interest you'll pay over time. Tracking your monthly spending can reveal where your money is really going and help you identify areas to cut back. Here's how to make the most of this strategy. Track every expense. Record everything you spend, from bills and groceries to coffee runs and impulse buys. Use a budgeting app, a spreadsheet, or even a simple notebook to jot down each expense. This transparency gives you a real sense of your spending habits. Identify budget cuts. Once you see where your money is going, look for areas to trim. Dining out, unused subscriptions, and entertainment are common culprits. Cancel subscriptions you don't use regularly and consider cooking at home more often. Cutting back in these areas can free up extra money for debt repayment. Set the goal to increase cash flow. The ultimate aim here is to increase your cash flow to pay off your debt faster. Reducing discretionary spending or the money spent on non-essentials is an effective way to do this. When you shift this cash toward debt repayment, you'll reduce your balances and pay less interest over time. Direct extra cash to debt. Each dollar saved from discretionary spending can go directly to your debt. Whether it's skipping a few takeout meals or pausing on entertainment expenses, every bit adds up. By putting these extra funds toward your debt, you'll see your balances shrink faster, bringing you closer to financial freedom. Remember, it's not about depriving yourself indefinitely. Small temporary sacrifices can impact your debt repayment journey, ultimately leading to more financial flexibility in the future. Increasing your income can supercharge your debt repayment efforts, allowing you to pay down balances faster and reduce interest costs. Here are a few ways to boost your earnings. 1. Freelance work. Leverage your skills. If you have marketable skills, such as writing, graphic design, programming, or social media management, freelancing can be a flexible way to earn extra cash. Sites like Upwork, Fiverr, and Freelancer connect you with clients looking for short-term help. Set your own hours. Freelancing often allows for a flexible schedule, so you can work around your main job and other responsibilities. A few hours a week can add to meaningful progress toward your debt. Explore remote gigs. Many freelance opportunities are remote, meaning you can work from anywhere. This reduces commuting costs and makes it easier to balance other commitments. 2. A part-time job. Steady income. A part-time job at a local business can offer consistent, predictable income that you can directly allocate to your debt. Many part-time roles also provide regular shifts, making financial planning easier. Explore flexible options. Consider options with flexible schedules like retail, food service, or delivery. Some part-time jobs, such as working at an event venue or tutoring, may have flexible hours that fit well around your main job. Seasonal work. During certain times of the year, like holidays, there's a surge in demand for seasonal workers. These temporary roles can be a great way to bring in additional income without a long-term commitment. Sell unused items. Declutter your home and earn cash by selling items you no longer need. Many items, from clothing to electronics, can be sold online or at local marketplaces. This is a quick way to reduce your debt without a significant time investment. 4. Consider side gigs. Gig economy platforms like Uber, Lyft, DoorDash, and Instacart provide flexible side jobs that can be taken on when you have free time. Earnings from these gigs may vary, but every bit helps when it comes to paying off debt. 5. Use extra income strategically. Commit to directing all extra income from these efforts toward your debt. While using additional earnings for other things is tempting, focusing on debt repayment can help you reach your financial goals faster and free up future income for savings or investing. Increasing your income is a powerful tool in your debt-free journey, and every bit you earn brings you closer to financial stability. Even small side gigs can accelerate your path to a debt-free life with consistent effort. If you're serious about managing your debt and achieving financial freedom, taking a strong stance against new debt is essential. Here's how to keep your finances on track. Avoid taking on new debt at all costs. New debt only adds to your financial burden, making it harder to make meaningful progress. Commit to managing your expenses with your existing resources so as not to compound your debt problem. Say no to offers for new credit cards or loans. They might be tempting, especially with promotions, but remember that every dollar borrowed now will need to be repaid with interest. Spoiler alert! Later in the video, I will explore a living debt-free tactic. Stop using credit cards. Take a break from credit cards and switch to cash or a debit card for daily purchases. This way, you'll only spend the money you have, which helps avoid accidental overspending. If you find yourself tempted, put your credit cards out of reach or even temporarily freeze your accounts. This break from credit can help you build a habit of spending within your means. Delay making large purchases. Large purchases can easily set you back on your debt repayment journey, especially when financed. Delay any non-essential big buys until you're in a better financial position. If you need a big-ticket item, start a savings plan for it. Setting aside a little monthly for the purchase prevents you from relying on credit, keeping your debt levels stable. Use debit card or cash for everyday expenses. Switching to a debit card or cash forces you to stick to your budget and can help curb impulse spending. With cash, for example, you physically see your money being spent, making you more aware of your spending habits. A cash envelope system might work well here. Allocate cash for specific categories, like groceries, entertainment, or dining out, so you stay within your limits. Staying committed to living debt-free. It may seem strict, but keeping a debt-free mindset means actively avoiding new debt while paying down what you already owe. These small lifestyle changes build financial discipline, helping you form habits that will protect your finances for years to come. By prioritizing debt management and committing to a debt-free lifestyle, you'll set yourself up for future financial stability and freedom. Remember, every step away from debt brings you closer to a life of greater peace and financial control. If your debt feels overwhelming, don't worry. There are resources and professionals who can help you navigate this challenging time. Here are a few options. 1. Credit counseling nonprofits. What they do. Credit counseling agencies, especially nonprofits, offer guidance on managing debt, budgeting, and financial planning. They often provide free or low-cost services, making them accessible even if you're financially stretched. Benefits. A credit counselor can help you understand your debt situation, set up a manageable budget, and may even help negotiate with creditors on your behalf. Many nonprofits can also set up debt management plans where you make one consolidated monthly payment to cover multiple debts at potentially reduced interest rates. Debt settlement companies. What they do. Debt settlement companies negotiate with creditors to lower your debt balance or reduce your interest rates and monthly payments. The aim is to reach an agreement for you to pay a portion of your debt, which can lead to more manageable payments. Considerations. While this option can make debt more manageable, it often comes with trade-offs. Debt settlement can negatively impact your credit score because it typically involves pausing payments while negotiations occur, leading to late payment marks on your credit report. Some companies also charge significant fees, so choose carefully and ensure the benefits outweigh the potential drawbacks. Financial advisors. What they do. Financial advisors can help you create a personalized debt repayment plan based on your overall financial picture, goals, and challenges. They often look beyond debt and can help guide you on budgeting, savings, and even investments, offering a comprehensive approach to improving your financial health. Benefits. Working with a financial advisor can be a great option if you're seeking a holistic approach to financial management. Advisors can provide tailored advice on prioritizing debts, improving your budget, and setting long-term goals. However, some advisors charge fees, so be sure to choose one whose services fit your budget and needs. Key considerations before seeking help. Research carefully. Many reputable credit counseling agencies and advisors exist, but be cautious of high fees and potential scams, especially with for-profit debt settlement companies. Understand the impact. Some options, like debt settlement, may temporarily impact your credit score, while others, like credit counseling, can help protect it. Know the possible consequences and weigh them against your immediate needs. Debt relief doesn't have to be tackled alone. Seeking support from these resources can provide expert guidance, emotional relief, and practical solutions to help you work through your debt in a manageable, effective way. Remember, there are paths forward, even in overwhelming situations. How to get lower interest rates. Getting a lower interest rate on your debt can significantly reduce the cost of borrowing, making repayment faster and more affordable. Here's how to improve your chances of qualifying for lower interest rates. Understand the role of your credit score. Your credit score is a key factor lenders use to determine interest rates. The higher your score, the lower the rate you're likely to receive, saving you money over the life of the loan. Building and maintaining a strong score can help you qualify for better rates even on existing debt, through refinancing or negotiating. Steps to improve and maintain a strong credit score. Check your credit report regularly for errors. Regularly reviewing your credit report allows you to spot inaccuracies that may be dragging down your score. Errors like incorrect account balances, duplicate accounts, or fraudulent activity can unfairly impact your score. If you spot an error, dispute it with the credit bureau to have it corrected. Monitoring your report can keep your credit score as high as possible. Pay your bills on time. Every time payment history makes up a large part of your credit score. Late or missed payments can negatively affect your creditworthiness, so set up reminders or automatic payments to ensure you never miss a due date. Consistent on-time payments signal reliability to lenders, which may lead to better interest rates over time. Keep credit utilization below 30%. Your credit utilization ratio, or the percentage of your available credit you're using, is another major factor in your score. Aim to keep your credit card balances below 30% of your credit limit, and ideally even lower. High utilization can suggest financial strain to lenders, leading to higher rates. Paying down balances can improve this ratio and, in turn, your credit score. Opening new credit lines, unless necessary. Every time you apply for credit, it can result in a hard inquiry on your credit report, temporarily lowering your score. Opening too many new accounts at once may also signal financial instability to lenders. Stick to essential credit lines, especially when focusing on improving your credit score for better interest rates. Monitor for identity theft and fraud. Monitoring your credit report can help you catch signs of identity theft, such as accounts you didn't open or unfamiliar transactions. Identity theft can severely damage your credit score and make qualifying for favorable interest rates harder. Promptly addressing any suspicious activity can protect your credit score and financial well-being. How to leverage your improved score for lower interest rates. Negotiate with lenders. If your credit score has improved since you first took out a loan, reach out to your lender to discuss a rate reduction. They may be willing to lower your rate to keep your business. Consider refinancing. Refinancing at a lower rate for debts like mortgages or auto loans can save you thousands over time. A higher score could mean significantly better terms. Transfer balances. Look for balance transfer offers with lower interest rates or promotional 0% rates for credit card debt. A strong credit score can help you qualify for these offers, reducing the cost of paying off debt. Taking these steps to improve and monitor your credit score opens the door to lower interest rates and strengthens your overall financial profile. With a lower rate, you can focus on paying down your debt faster, reducing stress and saving money in the process. Managing debt is a long-term journey that requires commitment, patience, and persistence. It's easy to feel discouraged, especially when the progress seems slow. But remember, every step you take is a step closer to financial freedom. Here's how to stay motivated and on track. 1. Remember your why. When you start to feel overwhelmed, take a moment to remind yourself why you're committed to getting out of debt. Whether it's financial stability, the ability to save and invest, or simply the peace of mind that comes with debt-free, keeping your goal in mind can motivate you to keep pushing forward. 2. Break down your progress into milestones. Instead of focusing on the total debt amount, set smaller, achievable milestones along the way. For example, celebrate each $500 or $1,000 you pay off, or the completion of each credit card balance. These milestones serve as reminders that you're making progress, no matter how small. 3. Celebrate small victories. Each win is worth celebrating, even if it's just sticking to your monthly budget or making an extra payment. Recognize these achievements with small, low-cost rewards like treating yourself to a favorite meal or a relaxing evening. These moments of recognition will keep you motivated and reinforce positive habits. 4. Track your progress. Visually create a visual representation of your debt repayment journey, like a debt thermometer, or a chart where you can shade in your progress. Seeing how far you've come can be incredibly satisfying and motivating, especially when progress feels slow. 2. Stay consistent, even when it's tough. Debt repayment is rarely a straight line. There may be months when expenses are higher or extra payments feel impossible. Adjust your budget and keep going instead of letting these setbacks derail you. The consistency you build will add up over time, even in small amounts. 3. Build a support system. Share your goals with a trusted friend, family member, or even an online community. Having support can keep you accountable, encourage you through tough times, and celebrate with you as you reach milestones. A strong support system makes the journey less lonely and more manageable. 4. Acknowledge your growth. Debt repayment isn't just about the numbers. It's also about building financial discipline, resilience, and self-control. Recognize how much you're growing along the way. With each payment, you're building skills that will help you stay debt-free in the future. By staying committed and celebrating your progress, you'll pay down your debt and transform your relationship with money. Every step you take brings you closer to financial independence and a future with less stress, more freedom, and greater financial confidence. As I promised, here is how you can avoid living in debt. An emergency fund helps you stay debt-free by providing a financial cushion for unexpected expenses, such as car repairs, medical bills, or job loss. Instead of relying on credit cards or loans when surprises arise, you can draw from your emergency fund, avoiding high-interest debt and keeping your finances stable. This reserve reduces stress, gives you control over your money, and protects your long-term goals, making it easier to stay on track and debt-free. Starting an emergency fund is easier than you might think. Begin with a small amount like $20 or $50. The key is to make this money liquid and easily accessible, meaning it should be in a savings account or a cash stash you can reach without penalties or delays. Even these small contributions build up over time, giving you a growing safety net for unexpected expenses. By setting aside a little each month, you'll quickly see progress, and this small habit can eventually protect you from needing high-interest credit when life surprises come up. Use sinking funds to stay debt-free. Sinking funds is a powerful way to stay debt-free. By setting aside small amounts of money over time for specific expenses, you reduce the need to rely on credit when those costs arise. For example, if you know you'll have a $1,200 car insurance payment due in 6 months, you should save $200 each month in a designated car insurance sinking fund. By the time the bill is due, you'll have the full amount saved, allowing you to pay it without stress or debt. Sinking funds can be used for irregular expenses like holiday gifts, home repairs, vacations, and even annual subscriptions, helping you anticipate costs and avoid the cycle of unexpected debt. Sinking funds are a budgeting tool that helps you save in advance for expected expenses, preventing the need for debt when those expenses arise. You set aside small, manageable amounts regularly for specific future costs, so you're financially prepared when they come up. Here's how it works. Identify irregular expenses. Start by listing expenses that don't occur every month but are part of your financial life. These might include annual insurance premiums, car repairs, holidays, back-to-school supplies, property taxes, vacations, and insurance detestable. Set a target amount and timeline. For each expense, estimate the amount you'll need and how far in advance you should start saving. For example, if you expect to spend $1,000 on holiday gifts in December and it's currently June, you'd aim to save about $167 each month until then. Open separate accounts and track separately. To avoid mixing these funds with your everyday spending, consider keeping each sinking fund in its own labeled envelope, a separate account, or a budgeting app. This keeps your savings organized and prevents accidental spending. Make regular contributions. Treat these contributions like monthly bills to ensure consistency. For example, if you have a $600 car insurance bill due in 6 months, put aside $100 monthly. You'll have enough saved to pay without using a credit card or loan by the time it's due. Stay flexible. Life changes, and so do expenses. Adjust your contributions or add new sinking funds as your needs shift. If an expense comes under budget, you can move the extra to another sinking fund or save it for a rainy day. By planning for irregular costs, sinking funds prevent the stress and burden of last-minute bills and unplanned expenses, making it easier to stay debt-free. They bring a sense of financial control, ensuring you have cash when needed, all without tapping into credit. Over time, this approach builds financial resilience and helps you confidently reach your money goals.